In 2026, the United States has the largest economy in the history of the world. Its stock market keeps hitting new records. Its companies build the chips, the software, and the weapons that everyone else depends on. By almost every headline number, America is winning. And yet, ask the average American how they're doing, and you get a strange answer. Not "we're thriving," something closer to "I'm tired. I don't know how people afford anything anymore. I'm not sure this is working." That gap between the number on the chart and the number in someone's bank account is where this video lives. Because here's the uncomfortable truth we're going to sit with for the next few minutes. America isn't broke. America is something stranger than broke. It's rich and stressed at the same time. Prosperous on paper, fragile underneath. And the machinery that's supposed to connect those two things, growth up top, stability down below, has quietly stopped working the way it used to. This isn't a story about a crash. Nobody's ringing an alarm bell. There's no single villain, no single headline you can point to and say, that's the problem. It's slower than that, and in some ways, more dangerous. So let's take it apart, piece by piece, not with panic, with patience. First, let's talk about why this matters right now, in the middle of 2026, and not 5 years ago or 5 years from now. Because the usual signals are confusing people on purpose, not maliciously, just structurally. Unemployment has stayed low. Inflation has cooled from its 2022 peak. The stock market keeps climbing, driven largely by a handful of massive technology companies riding the AI boom. If you only read the headlines, you'd think the economy is in great shape. But underneath those headlines, something else is happening. Household debt is at record highs. Credit card delinquencies have been climbing. A huge share of Americans say they couldn't cover an unexpected $400 expense without borrowing. Younger generations are delaying home ownership, delaying marriage, delaying having kids. Not because they don't want those things, but because the math doesn't work. Here's the part that should make you sit up. The stock market and the economy used to move together, roughly. When the market did well, it was because companies were doing well, and companies doing well meant workers were doing well too. That link has been fraying for years. Today, roughly the top 10% of Americans by wealth own about 87% of all stock market value. When the market goes up, it's mostly good news for people who already had money. So when someone tells you the economy is booming, ask them a simple question. Booming for whom? That's not a slogan. It's the actual fault line running through everything we're about to talk about. Now let's build the picture from the ground up. How does an economy actually work, stripped of the jargon? Think of it like a household, scaled up to 340 million people. Money comes in. Wages, business profits, investment returns. Money goes out. Food, rent, healthcare, debt payments. And in between, there's a government trying to keep the whole system stable, mostly through two levers: how much it spends and taxes, and how expensive it makes borrowing money. For decades, the American version of this system ran on a simple promise: work hard, get educated, and your standard of living will beat your parents. Wages will rise with productivity. Debt will be manageable. Retirement will be possible. That promise was mostly kept from the 1940s through the 1970s. Then something shifted. Starting in the late 70s and accelerating through the 80s and 90s, wages and productivity began to decouple. Productivity, how much value a worker creates per hour, kept climbing. Wages, adjusted for inflation, mostly flatlined for the median worker. Picture two lines on a graph, starting together in 1973, holding hands like old friends. Then one line keeps climbing steadily upward. The other basically goes sideways for 50 years. That gap between the lines? That's not an accident. That's decades of profit growth being captured by capital. Shareholders, executives, owners. Instead of being shared with the people generating it. This is the first mechanism you need to understand. Growth didn't stop. Distribution changed. Now, layer debt on top of that. When wages stall, but the cost of living doesn't, people have two choices: consume less or borrow more. America chose door number 2 at almost every level. Households borrowed more: credit cards, auto loans, student loans, mortgages. Total US household debt now sits above $18 trillion. Student loan debt alone is close to $1.7 trillion, more than Americans owe on credit cards and auto loans combined. Corporations borrowed more, not always to build new factories or hire more people, but often to buy back their own stock, which pushes share prices up without necessarily creating anything new. It's financial engineering dressed up as growth. And the government borrowed more. Much more. The US national debt has crossed $36 trillion. To put that somewhere, you can actually feel it. That's roughly $106,000 for every single person in the country, newborns included. Here's the quietly absurd part. The government now spends more on interest payments for that debt than it spends on national defense. Let that sit for a second. The cost of past borrowing has become bigger than the military budget of the most powerful country on Earth. Debt isn't inherently a crisis. Countries carry debt all the time. The question is always the same one. A bank asks a person applying for a loan, can you service it? Is income growing fast enough to cover the payments without squeezing everything else? For the US government right now, the honest answer is, it's getting harder every year. So here's the mechanism hiding underneath the headlines. And this is the part most explainers skip, because it's less exciting than a crash, but it's the actual engine. The Federal Reserve controls interest rates. When it raises rates, borrowing gets more expensive, for the government, for companies, for you. When it lowers rates, borrowing gets cheaper, which usually stimulates spending and investment. Since 2022, rates have stayed elevated to fight inflation. That's painful for regular borrowing, but it's brutal for a government carrying $36 trillion in debt, because a huge chunk of that debt needs to be refinanced at these higher rates every single year. Here's the trap. To fight inflation, you raise rates. Raising rates makes the government's debt more expensive to service. Servicing more expensive debt means either cutting spending elsewhere, raising taxes, or just borrowing even more to cover the interest. Borrowing more to pay interest on existing debt is not a strategy. It's a treadmill. This is sometimes called fiscal dominance, a fancy term for a simple, uncomfortable idea. At a certain point, the size of the debt itself starts dictating monetary policy instead of the economy's actual health dictating it. The tail starts wagging the dog. Nobody wants to say this plainly in an election year. It doesn't poll well, but the math doesn't care about polling. Now let's talk about inflation itself, because this is where hype and reality really split apart. Officially, inflation has come down significantly from its 2022 peak of around 9%. Politicians point to that number like it's a finish line. But inflation cooling doesn't mean prices went back down. It means prices are still rising, just more slowly than before. Groceries, insurance, rent, healthcare. These are still meaningfully more expensive than they were in 2020. And wages for a large share of workers haven't fully caught up to that new, higher baseline. Here's a small, almost funny detail that captures the whole dynamic. Companies have quietly figured out that people notice price increases more than they notice size decreases. So instead of raising the price of a bag of chips, they shrink the bag and keep the price the same. Economists call it shrinkflation. It's a technically accurate word for a company betting that you're too busy to weigh your snacks. That's the small, visible version of a much bigger pattern. Corporate profit margins, in aggregate, have stayed near record highs through this entire inflationary period. Some economists argue this shows companies didn't just pass along higher costs. Many use the cover of inflation to expand margins beyond what rising costs actually required. It's a theory with real critics, and it's genuinely debated. But the fact that it's even a plausible debate tells you something about how murky the line between necessary price increase and opportunity has become. So, inflation slowing is real. Relief for the average household is a lot less real. Let's zoom into one specific corner of this story, because it explains a lot about who this economy is currently built for. Housing. In 1985, the median home price was roughly 3.5 times the median household income. Today, that ratio is closer to 6 or 7 times income in much of the country, and considerably higher in major cities. Mortgage rates that once sat comfortably below 4% have spent much of the past 2 years closer to 7%. Do the math on that combination. Higher prices, higher rates, and you get a brutal outcome. Housing affordability, by several standard measures, is near its worst point in decades. A generation that was told homeownership was the foundation of the American dream is discovering the foundation has been quietly priced out from under them. Meanwhile, institutional investors, private equity firms, large landlords, have been buying up single-family homes in bulk in some markets, turning what used to be starter homes into permanent rental inventory. It's not the majority of the market, but it's a visible, symbolic shift. A growing number of Americans aren't failing to buy a home because they're irresponsible with money. They're competing against entities with essentially unlimited capital. This is the uncomfortable math nobody wants to say out loud at a dinner party. For a large and growing share of young Americans, the traditional path: work, save, buy a home, build equity, retire comfortably, is no longer mathematically available on a normal salary. Not because they're lazy, because the equation changed and nobody updated the story we keep telling them. Now zoom out further, because housing is just one symptom of a bigger pattern: concentration. Across industry after industry. Airlines, telecom, healthcare, tech, banking. The number of major players has shrunk over the past few decades. Mergers and acquisitions have consolidated market power into fewer hands. 4 airlines control about 2/3 of US domestic air travel. A handful of tech companies now account for a large share of total stock market value. In banking, the biggest institutions hold a larger share of total assets than they did before the 2008 financial crisis. The crisis that was supposed to teach everyone the danger of too big to fail. Here's the irony worth sitting with. The 2008 crash happened partly because a small number of financial institutions had grown so large and so interconnected that their failure threatened the entire system. The policy response was supposed to prevent that kind of concentration from happening again. Instead, the biggest banks today are bigger than they were in 2008. Concentration isn't automatically evil. Big companies can mean efficiency, lower prices, faster innovation. But concentration without competition tends to drift toward the same outcome every time in economic history. Pricing power shifts from the consumer to the company, and wage power shifts from the worker to the employer. You end up with an economy that looks dynamic on a stock chart and feels stagnant in a paycheck. So let's put the pieces on the table together, because individually, each one sounds manageable. Together, they tell a different story. Wages decoupled from productivity starting in the 1970s. Debt, household, corporate, and government, expanded to fill the gap that stagnant wages left behind. The government's own debt has grown so large that interest payments now compete with core priorities like defense and infrastructure. The Federal Reserve is stuck in a bind where fighting inflation makes the debt problem worse and easing up risks reigniting inflation. Housing, the traditional engine of middle-class wealth building, has become mathematically unreachable for a huge share of the next generation. And market power has concentrated into fewer hands across almost every major industry, quietly shifting negotiating leverage away from ordinary workers and consumers. None of these, alone, is a crisis. Combined, they describe an economy that has gotten extremely good at generating wealth and increasingly bad at distributing it, and increasingly boxed in when it comes to fixing that without causing pain somewhere else. This is the hype versus reality gap in one sentence. The hype says, record markets, low unemployment, resilient economy. The reality says, record debt, stalled mobility, an economy running hot for those who already hold assets and running on fumes for those who don't. Both of those things are true at the same time. That's not a contradiction. That's the actual shape of the American economy in 2026. Here's where the stakes escalate, because this isn't just an American story anymore. The US dollar is the world's reserve currency. That status gives America extraordinary privileges. It can borrow more cheaply than almost any other country, because the entire world wants dollars and dollar-denominated debt as a safe place to park money. That privilege is part of why $36 trillion in debt hasn't already triggered a crisis. But that privilege isn't a law of nature. It's a level of trust built over 80 years that the dollar and US debt are the safest bet on the planet. Trust like that is expensive to build and, historically, surprisingly fast to erode once cracks start showing. In recent years, you've seen quiet signals of exactly that erosion. Some countries have been diversifying their reserves away from the dollar. Gold purchases by central banks have risen. None of this means the dollar is about to collapse. It almost certainly isn't, not soon. But it means the system America has relied on to keep borrowing cheap, even while running historic deficits, is not a guarantee. It's a habit the rest of the world could, in theory, break. If that trust ever meaningfully cracked, even partially, the cost of America's debt wouldn't just be a budget line item anymore. It would touch mortgage rates, government services, the value of savings, the price of nearly everything. The treadmill we talked about earlier would speed up, not slow down. That's the scale of what's actually at stake underneath all these numbers. Not just can the average family afford groceries, but can the country that everyone else's financial system is built on top of keep affording itself? So where does that leave us? Not with a prediction of collapse. This video isn't trying to sell you fear, and anyone telling you they know exactly when or how this resolves is selling you something. What we can say, calmly and with the receipts laid out, is this. America's economy has become extraordinarily good at creating wealth at the top and extraordinarily strained at distributing stability everywhere else. It has built a debt structure that limits its own future choices. It has let market power concentrate to a degree that quietly tilts the field. And it's running all of this on the borrowed trust of the rest of the world, a trust that is held for 80 years but was never actually guaranteed to hold forever. The people who benefit most from this system have every incentive to keep telling you it's fine. And in the narrow sense that matters to them, it is fine. The market is up. Their assets are compounding. Nothing about their daily life feels strained. For everyone else, the question isn't whether the economy is growing. It clearly is. The question is whether growth still means what it used to mean, whether it still translates into a better life for the person doing the work. That question doesn't have a clean answer yet. Maybe it never will. Maybe the answer arrives slowly, in the form of a generation that simply lives differently than the one before it. Renting instead of owning, retiring later instead of earlier, adjusting its expectations downward and calling it realism. Or maybe the answer arrives all at once, the way these things sometimes do, when a system that looked stable for decades turns out to have been quietly running on assumptions nobody bothered to check. Either way, the chart at the top and the num, burn your bank account are telling two different stories right now. The real question is, which one of them is lying to you?